Let's get started with Chapter 3, which is Accounting Information Systems. In this chapter, we're going to learn the basics of bookkeeping. As you well know, today most companies use accounting software to record all their bookkeeping functions. However, this is the foundation of a business, and we need to understand what goes into that software. A computer is only as smart as you give it instructions. So we need to know what instructions we're giving the computer as far as the business cycle is concerned. Not all business events result in an accounting transaction. So what we do in this chapter is we go through the steps to decide whether it's a business transaction which merits an accounting journal entry. If the business transaction affects assets, liabilities, or owner's equity accounts, it is an accounting event. The first place where we record this information is in the journal, and that process is referred to as journalizing a transaction. After the transaction has been journalized, we transfer the information into the second book, which is the ledger. That process is referred to as posting. At the end of a period, you take the accounts, all the balances of all the accounts, and you put it into one sheet, and that is referred to as the trial balance. This is prepared on a weekly or a monthly basis, after which we have adjusting entries, the adjusted trial balance, financial statements, etc. It's only these first three steps that we're going to address in this chapter: journalizing an entry, posting into the ledger, and then preparing the trial balance. So these are the first three steps of the accounting cycle. So let's look at our homework problem, which is problem 3-4A. So going back to the textbook here for a second. Going back to our textbook here for a second, let me pull up our homework problem in just a second here. So let's scroll down to problem 3-4A. Okay. So we have Bradley's Miniature Golf and Driving Range, Inc., which opened on March 1st. We have selected events and transactions that have occurred in March, and they're presented to us. They tell us the company uses the following accounts. They have given us the account names. They've asked us to journalize the transactions, including explanations. I'm going to skip this part, and I will tell you why I'm skipping the part. They've also told us that Bradley's records golf fees as service revenues. Now I'm going to be doing my work in Excel. You will be doing your work on Wiley Plus, and that looks a little different, as you already know. So what we're going to do over here is, in addition to doing the journal entries, I'm going to do the step before, which is transaction analysis, and I will do the step after, which is posting into the ledger. I'll explain that to you, and subsequently we'll do the trial balance. So the very first transaction on March 1st, stockholders invested $50,000 cash in the business in exchange for common stock of the corporation. So I want to analyze the transaction. I want to see its effects on assets, liabilities, owner's equity. Owner's equity, as you know, has common stock and retained earnings. Retained earnings has net income, which is nothing but your revenues minus your expenses. And from retained earnings, we pay dividends. So each transaction that happens, we will see how it affects these accounts. So if the owners put money into the business, once again, remember, all the accounting is done from the viewpoint of the business. The business got $50,000 cash. Cash is an asset, so my asset increased by $50,000. The company issued common stock, basically telling the owners, you are now the owners of the business. So common stock increased by $50,000. There was no effect on liabilities. I don't need to put anything here, but for this one, I'll just say it's zero. and also no effect on retained earnings for this transaction. So I've done the analysis of the transaction. Let's see how the journal entry is going to play out. A journal entry is nothing but a book in which I'm going to document every business transaction. So think about it when you had a personal journal. What did you do? At the end of each day, you'd write down things that happened to you that were significant. So always we start out with a date. We will identify the account names, the accounts that were affected. We will identify whether the accounts were debited or credited. And we're going to have this column for posting reference. Okay. So I've introduced some terms over here which you have heard forever and a day. Debits and credits, that's what accounting is all about. Well, it kind of is the foundation of how we structure things in bookkeeping. It was the oldest known documentation was in 1400s, and it's still used today, even in the accounting software. So let's see what this is before I get into the journal entry. Basically, when we're talking of an account, we're talking about collecting all the information about any one particular piece of item. So I set it up as a T account. That T account is literally as you see this little picture over here for me, T. On top, I will write the name of the account. And what do I have in the T? There are two sides. Okay. We call one side the debit side, the other side the credit side. These come from Latin words, and they are abbreviated as DR and CR. And really all they are, or what they mean, is the left-hand side and the right-hand side of the account. Debits and credits do not mean good and bad. They don't mean increase or decrease. Nothing of the sort, just left-hand side and right-hand side. So then what exactly do debits and credits do for us? Well, they basically are a way in which we track the effect of all the transactions on assets, liabilities, and owner's equity. So let's start with, always assets are increased with debits. So normal balance for assets is debit. The opposite is true for liability and stockholders' equity. Now, an easy way to remember this is using an acronym. The acronym we are going to use is DEAD. Yeah, I said DEAD. D-E-A-D. So what does this mean? We debit all expenses, all assets, and dividends. In order to increase these accounts, expenses, assets, and dividends, we debit them. In order to decrease each of these, we're going to credit them. So the opposite is going to be true for the accounts I did not mention, which would be liability, common stock, retained earnings. Okay? So let's come up to our journal entry. Our transaction took place on March 1st. The account that was affected was cash. My cash increased. Cash is an asset. I increase it with a debit. So in the debit column, I put $50,000. Common stock is an equity account that increases with a credit. Okay, so we've done with our first journal entry. What happens to this journal entry? Well, it's going to sit in the journal, and I need to transfer the information somewhere else so that it becomes easier to deal with later on. So I'll tell you what it means. I'm going to open a T account for cash. I'm going to open another T account for common stock. Cash was debited $50,000. So if you see over here on the left-hand side, I transfer that $50,000. That process is called posting. When I take it from the journal into the ledger, it's called posting. So this is the ledger accounts we're looking at. Common stock was credited. So on the right-hand side, I'm going to post $50,000. So we've completed the first three steps. We analyzed the transaction, we journalized, and we posted into the ledger. The posting reference really, all it was in the past when everything was done manually, just to make sure I know that I have transferred the information. I'd put a check mark or some kind of notation over here saying it's done. Okay, so I put an X or I put a check mark and say that that number has been transferred, so I don't do it a second time and make a mistake. Now let's take a look over here. In the next transaction on March 3rd, I purchased golf land for $38,000 cash. When I purchased and it says for cash, it means I paid cash. So my cash decreased. I, the business, my cash decreased. What did I get in exchange for $38,000? I got land that's appraised at $23,000. I got a building that's appraised at $9,000 and equipment $6,000. And they want us to put all of this in a single entry. So let's see how I'm going to do that in my spreadsheet. So I first start out with my analysis. My assets, cash decreased by $38,000. What did I get? I got land, which is an asset. I got building, that's also an asset. And I got equipment, that's also an asset. So 3 assets increased and another asset decreased. So what's the net effect on assets? I had $50,000 before I started. It stays the same. When you add up, was there an effect anywhere else on the accounting equation? The answer is no. So let's set up the journal entry and see what happens. I have land debit, building debit, equipment debit, cash credit. Okay. Let me go ahead and post the information. So I open another account for land. I open an account for building. I open an account for equipment. I'm not going to open another account for cash because I already have it. Okay. So land is debited $23,000. Building is debited $9,000. Equipment is debited $6,000. Cash is credited $38,000. So if I already have an account, I'm going to use the same account. The whole idea was in an account, I gather all information about the account over here. Now let me mention one more thing over here. A couple things before we proceed. There are accounting rules and accounting conventions. The accounting rule, as far as journal entries are concerned, the first rule that has to be followed is every transaction must have a date. If not, the transaction is invalid. Every transaction must have at least one account debited and at least one account credited. So here you see there are multiple debits and one credit, that's fine. Every transaction must have total debits equal total credits. So within this transaction, I have debited $38,000 and I've credited $38,000, and that's fine. So again, accounting rules, we must have a date for each transaction, at least one debit and one credit. For each transaction, total debits must equal to total credits. Then there are some accounting conventions. Convention simply means that's how accountants do it. Those of us who are older and have done things manually, we were quite obsessive about doing this exactly this way. So what am I talking about over here? An example of an accounting convention is I always list my debits first and then I list my credit within a journal entry. So if you had said common stock credit 50,000, cash debit 50,000, it's perfectly correct. But it doesn't follow the accounting convention of listing debits first and then credits. Another accounting convention is we indent the credit just so that visually when you see, you say, yeah, I did credit an account over here. A third accounting convention is we write an explanation for every journal entry so that when we go back and see what it is, we have some point of reference. And that's the reason I told you I'm going to skip it now. It's not required. It'll save me some time as we're going along over here. But you get the idea. Again, I'm going to go with the accounting rules. Every transaction must have a date. Every transaction must have at least one debit and at least one credit. Total debits must be equal to total credits. So accounting rules we cannot compromise on. In fact, in the accounting software, when you open the accounting software to do a journal entry, it auto-populates with the current date. What that means is it automatically puts the current date over there unless you put a different date. So it doesn't even give you the option of moving without a date. It will ask you for debits first, credits second. If you give it in the reverse order, it's fine. It'll just reorder the account. So it takes care of it. If your total debits are not equal to your total credits in a journal entry, it will not let you post into the ledger. It just stops you. So I guess the accountants, when they help the software engineers write the programs, they kind of snuck in all these conventions and made them rules. So if you use a software, all of these are inbuilt. Okay, let's go back to our problem and see what the third transaction is. We advertised the opening of the driving range and we paid $1,200 cash for it. So let's go back over here and see what happened. I paid cash, so cash decreased. That's fairly obvious. What did I get in exchange for this? What I got was a benefit. The benefit I got is called advertising expense. The benefit is hopefully going to be, it's going to help me generate revenue. It didn't have an effect anywhere else. So let me redo my calculations and see what my numbers stand at. Okay. It's always a good idea every so often to make sure that the accounting equation is in balance, which is basically total assets must equal to total liabilities plus stockholders' equity. My total assets is $48,800. Common stock minus the expenses is also $48,800, so I'm in good shape. Let me come to my journal entry. I'm going to do my journal entry, advertising expense debit, cash credit for $1,200. Okay, let me move out over here and I will tell you why I'm not going to proceed with posting into the ledger. I posted the first two journal entries. As soon as I did the journal entry, I posted into the ledger. That is referred to as real-time posting. That's using computer language. It means after every journal entry, it automatically posts into the ledger. We can do that. Or we can do what's called batch posting. In batch posting, you wait until the end of the day, end of the week, or end of the month to post everything from the journal to the ledger all at one time. Both methods are equally acceptable. It's just a matter of what you prefer how you prefer doing this as an accountant. What you will notice these days is with the accounting software, the setup wizard will ask you, would you like real-time posting or would you like batch posting? It even makes suggestions to you based on your business, what method you should choose. Okay, so I'm going to now say I'm going to do batch posting, which means I'll do it all at the end. I'm not going to look at it until then, just to save some time for myself in the explanation process. Let's go back to our problem. On the 6th, we paid $2,400 for a one-year insurance policy. Okay. I paid cash. Again, cash decreases. Okay, just a second here. I paid cash, cash decreases, $2,400. So in my journal entry over here, I'm setting up my journal entry. The part that I know is cash has decreased $2,400. I need to debit something for $2,400. Okay. I paid for insurance, which is insurance expense. I'm doing my accounting for the month of March. It's a one-year policy. I still have to get benefits out of it in the future. So at this point of time, I will call it prepaid insurance, which is an asset. I still have to get the benefit from this asset. As time goes by, it'll become insurance expense. But until such time, it'll stay as an asset in my books. So there's no effect anywhere on the total amounts because both were assets that was affected. One asset increased, another asset decreased. Okay, let's look at the next one. We purchased golf clubs and other equipment for $5,500 from Tahoe Company, payable in 30 days. This means I have not made my payment right now. I will pay for it in the future. I'm liable to pay for it. This word payable means it's a liability. So Going down over here, I have purchased an asset for $5,500. I will pay in the future, which means I've incurred a liability for $5,500. No effect on equity. Okay, let's see how our journal entry is going to look. Equipment account debit, accounts payable. Whenever you see the word payable, it's a liability. Credit $5,500. Okay, let's go back here. On the 18th, we received golf fees of $1,600 in cash from customers for golf services performed. So what we have now is cash increased by $1,600. Why did we get this cash? Because we performed the golf services, which means we earned revenues. Has no effect on liabilities or common stock. This money did not come from the investors. They came from customers. So it's revenues. It's not common stock. So let's check our totals. So I now have $55,900 in assets, $5,500 in liabilities. The common stock has stayed at $50,000. I have revenues of $1,600 and expenses of $1,200. Let's look at our journal entry. Our journal entry is cash debit, service revenue credit. Our next transaction says we sold 100 coupon books for $25 each in cash. Each book contains 10 coupons that enable the holder to play one round of miniature golf or to hit one bucket of golf balls. They're also giving us a hint. The revenue should not be recognized until the customers use the coupons. So what's happened is we got money in advance and we have an obligation. An obligation means a liability. Okay, so let's see what we'll do over here. I know I got cash. So I sold $25 worth of booklets. Each booklet was $25, 100, so that works out to $2,500 what I got. But this is a liability in my books. So my liability increases by $2,500. So let's look at our journal entry. The part that's easy is the debit. I know cash is debit. I have to credit something else. I can't credit revenues because it's not yet revenues. I have to credit a liability. And we try to go with the most obvious name. So the name we are going to use is revenues, but we're going to say it's unearned revenues. Just like the word payable suggested it's a liability, the word unearned suggests it's a liability. Okay. On the 25th, we paid $500 in cash dividends. Who do we pay the dividends to? We paid dividends to the owners. So I paid cash. So cash is going to decrease by $500. So in my journal entry, I know cash is credit, $500. Dividends are always paid out of retained earnings. Okay, so it's going to decrease retained earnings. The 500 will be on this side under dividends and will be a subtraction. So, and once again, just to refresh our memory, dividends have to be debited. Remember the acronym I had showed you earlier? DEAD, debit all expenses, assets, and dividends to increase them. So dividends, we paid dividends, which means it increased. So we have to debit dividends. The only reason I put this in parentheses over here is to indicate it's going to reduce my retained earnings. Okay, let's go back to the problem and see what next. On the 30th, we paid salaries of $800. Salaries is an expense. The employees worked for us. We got the benefit. That's how we earned our revenues. So it's an expense. We paid them cash. So our assets are going to decrease by $800 and retained earnings is going to decrease by $800. So at this point of time, my journal entry is going to be on March 30th, salaries and wages expense debit, cash credit for $800. And then on the same day, I paid Tahoe Company in full for equipment purchased on March 10th. So if you look back on March 10th, we had purchased equipment on account. We had to pay that $5,500. Now they're telling us we paid the $5,500. So March 30th, I paid. Okay, so cash will decrease, so cash has to be credited. What should I debit? Remember this $5,500, this accounts payable? In order to establish the accounts payable, I credited it. In order to decrease it, I'll have to debit it because I no longer owe that money. I'm paying it off. So it's going to decrease my liability. And I think we have one more transaction. Yes. On the 31st, we received $900 in cash from customers for golf services performed. Now, this is again similar to what we had on the 18th. So that should be fairly easy. We received cash, so cash increased. It's revenues. So the revenues go up by 900. So March 31st, the journal entry is going to be identical to this one that we had on March 18th. Cash debit, service revenue credit for $900 each. Okay, now that we've done all our journal entries, we will do the batch posting. And in my case over here, since I've already done this work, I'm just going to show you what it looks like and give you some explanations. Okay, after you transfer all the information from the journal into the ledger, at the end of the period, which is end of the month here, I want to find out what the balance is on each of these accounts. So I add up the debit side, I add up the credit side. For cash, $55,000 is the debit side total. $48,400 is the credit side total. I take the difference between the two and that's the balance. And I put it on the side which is larger, and that's the normal balance for cash. Cash is an asset, normal balance is debit. You'll also notice an accounting convention, I put a double underline under this total. That's again visually just to know what that number is that I need to take over to the next step, which is a trial balance. Any account that has only one posting in it, I can just draw a double line under it, indicating that's the balance, which is the case for most accounts. Equipment, I had two debits. I add up on the debit side. Revenues, I had two credits. I add up on the credit side. Accounts payable, I started out with a credit, and then I had a debit of the same amount, leaving me with a zero balance. I put the zero on the credit side simply because accounts payable is a liability and you want to put it on the credit side. It really doesn't matter because it has a zero balance. Okay, so what's the next step that we need to look at? The next step I need to look at is the trial balance. Okay. A trial balance is an internal document. We typically don't share this with anyone outside of the company, but it is one of the formal documents even internally that the accountants maintain. And anytime something is formal, you want to prepare it properly, which means I start out with a header, which has the name of the company. Second line, I identify what the statement is, which is a trial balance. And the third line, I'm going to write the date on which the trial balance was prepared. I will then write the list of accounts, so I head it with the account name. And then I identify whether I have a debit balance or a credit balance in the account. I start with the first one I have in my list. The first one I have is cash. It has a debit balance of $6,600. The second account is common stock. I have a credit balance of $50,000. So I go down the list and bring all the numbers in over here. Okay. So the one account I did not bring from the ledger to the trial balance is accounts payable. That is because the trial balance lists only accounts that have a non-zero balance. Accounts payable has a zero balance, so there's no need for me to bring it in over here. I now total the two sides, and they should work out to be the exact same number on both sides. So it's just one way of verifying that in your journal entry, your total debits were equal to total credits. This doesn't necessarily mean that what I have done is correct, but it's just one small verification about that I'm on the right track at least. So this covers one half, or at least the first 4 steps of the accounting cycle. In Chapter 4, we'll go through the remaining steps of the accounting cycle.